Greetings, everyone. How you doing?
I'm good. How are you? It looks like my coffee cup matches my shirt.
I'm doing well. Actually, that's
interesting.
Hurt my eyes.
So we are doing the state.
So if you're wondering what's going on in the markets,
we're staring at each
ours
other.
Personal and predictions and what's going on generally, we will let you know right after this.
I love that.
As you know, all this commentary is our personal information,
which is always correct.
And we get the data from typical sources.
People on the streets.
That's right.
And also, from our experience, as well as our observations as active lenders, investors.
And all of these incredible masterminds that we are blessed to be members of.
You can see by the bags under these eyes, I got plenty of experience.
Yeah.
So thank you, folks, for joining us on the Real Estate Investor Show. We are Carolina Hard Money, or Carolina Capital Management. I keep getting our name wrong. Why do I do this?
I don't know.
I'm staring right at a teleprompter, and I don't even read the thing.
Okay, look at
All right,
it.
we are lenders for the Southeast for real estate investors. If you are interested in borrowing money, go to carolinahardmoney.com. Click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and sign up with Wednesdays with Wendy.
And look, we have a comment from Valerie Townsend. She says, I have an appointment in May. I hope that's with me.
Sure it is.
Yeah. How cool.
I haven't started.
I don't
June's
accept
with
appointments.
Jonathan.
I'm just kidding. Valerie, you will get a lot out of it. So I'm glad you signed up. Now, that said, Wendy devotes 30 minutes per person on Wednesday each week. Go ahead and click on that link that has her calendar.
Oh, yeah, she is
She's
coming.
usually booked out a couple of months in advance. So get on there quickly. And by the way, that's our chat box to the side
or below.
Or underneath, depending. Thank you, Jonathan.
No problem.
Depending on the platform that you're viewing us from. So I have a nice announcement.
What is it?
We are now available on another platform. What is it?
I don't know.
Oh,
next we just want to let's get ready to rumble.
Rumble. That's right.
So we're now available on Rumble.
I guess I'll have to sign up for that so I can see us.
Yeah.
Another video alternative.
Cool.
Excellent.
We're so hip. Thank you, Scott.
Yes, we are.
That's awesome. So excitement, Bill.
Yeah. So today we're talking about
We are now going to talk about Sweet.
All these new, yeah.
Sorry, I'm all data and no effects.
Thank you, Randy.
By the way, those of you that are in your car or listening on just the audio,
yeah, you're missing everything.
No idea what's going on. We have these wonderful.
We have dancing girls
that the team has put together. It really is awesome.
Yeah.
So we kind of touched on supply and demand last week.
Yeah.
And we have a fresh off the presses, upside down, article from the Mecklenburg Times. I always say this, if you're in the Charlotte metro area and you're a real estate investor, you need to get a subscription to this. It comes out twice a week, whether there's news or not. But there's an article in here about millennial demand driving up prices in neighborhoods with kids. So just to touch on an overview here, they took the top 10 zip codes that had the largest amount of kids in them. And the prices on those zip codes have gone up 21 point some odd.
Very interesting. And I'll bet that is nationwide.
Yeah.
Oh, yeah.
What I'm talking about.
Very, very interesting.
And then it was only up it's only up 17% for those zip codes that had the smallest amount of children.
Right.
So if people are wondering if the housing market is going to slow down,
No.
that's right. Millennials now make up more of the population than the baby boomers, which baby boomers were the largest, but a few of us have
Some of us just getting
passed
larger.
along.
Yeah.
And so millennials are now in their prime home buying age.
That's
age
right. That's
Yep.
right.
It's the average age of millennial, 34, 33, something like that.
And that's when
Mhm.
they usually do the first time home buyer. So
Yeah.
it's really just strange. You know, it's like making this big giant pot of soup, putting in all kinds of things, and you really don't know what's going to come out of it. You know, we've got recessional numbers. We've got, the barrel of oil came down $6.
Mhm.
But mortgage interest rates are like insane huge.
They are.
Like we had 3 raises in the past 4 days or 5 days.
3 in the past week and a half.
Yeah,
that's
it's
for sure.
it's
Yeah.
crazy. It's just been
So let's touch on those individually. How about that?
The rates.
yeah. I was just kind of doing an all around kind of
An
thing.
overview.
Yeah.
That's a great segue, Wendy.
Thank you. I was working on that all day.
So the rising rate environment,
Actually, I'm going to start off with business is booming.
business is booming. Okay.
Now, for us personally, as a business, as a lending company, we have done in the first quarter, or
Tell
have
everybody.
closed in the first quarter, what we closed all of last year.
Yeah. So it's been good.
I'd say
It's
so.
been good. We're happy.
So
Our investors are happy.
last year was a record for us, and obviously this first quarter has also been a
Yeah.
record.
Yeah.
That said, we offer additional programs that we didn't
Have before.
Well, we had it last year, but we had just started with it.
Right.
Yeah.
Right.
And that gets us to the rising rate environment.
Mm-hmm.
So
Well,
I'll let
let's
you
talk
guys-
just a minute too about the programs that we've added, because it's not just us. There's a lot of other companies that are doing similar programs, although we'd love you to just use us, but there are other companies that are doing similar programs, and they're kind of unique where that money's coming from. And it's
Yeah.
the non-qualifying loan, right?
Correct. Well, yeah. So you have non-QM, and then you also have private money as well.
Mhm.
And non-QM and private, they can source their capital from similar places, sometimes the same places. But non-QM is typically going to have like institutional capital behind it, where the private side can have that, but doesn't always.
And when we say institutional, you don't mean bank money.
I mean, it can be bank money. It can be, government sponsor, anything that's government sponsored money.
Okay. Okay.
On the private side, you get a lot of companies that have large hedge funds
Mhm.
that invest hundreds of millions, or in some cases billions of dollars
Mhm.
into them, and they can source that. Again, they can source that from conventional or institutional sides, or they can source it like we do from individual investors.
Well, let's back up just a little bit. The non-qualified, what that means is it's not a Fannie Freddie type of
Right.
It's not
Get it in your
guaranteed. It's not
LLC.
guaranteed by the government.
Right.
And the non-QM, the majority of the non-qualified loans they have an owner-occupant component to it. So it could be a second home, could be their primary residence.
Yeah.
When you get into the investor side, you can still go through those same companies, but there's
Mhm.
also a lot of other companies out there that will offer more of a commercial loan.
Yeah,
So it wouldn't
easily
close in your
underwritten.
name; it would close in the name of the business,
Mhm.
and it is.
They're not even looking at tax returns
It's-
in many cases, right?
We on ours we
Yeah.
do not either.
Yeah.
Most of the time, it's underwritten based on the income that the property.
Right.
Yeah, so it's
very
yeah,
asset based.
Yeah, so it's debt service coverage ratio, which is just the gross income on the property equals or outweighs the debts paid on the property, which is your PITIA, principal, interest, taxes, insurance, and association fees. So
Now, they would appreciate it if it outweighed, because they want you to make money if you're
Yes.
an investor.
Yes.
I mean, most of them,
We do
like
too.
if you do like a single family home on an investment, it's a 1-to-1 DSCR as long as it covers it.
And
Now,
say what 1-to-1 means. If it's
if
160.
you're making $1,000 rent, then your expenses on the property, your taxes, your principal, your interest, your insurance, all that can be $1,000, and they'll still do it,
Right.
Because it covers it.
But keep this in mind as an investor.
Mhm.
You don't want a 1-to-1. You want to make money.
Yes.
There's no point in buying
Yes.
these things just to
Break
hope
even.
that the property value is going to be worth more down the road.
Right.
Because now you're gambling or you're a speculator.
Right.
You're not an investor,
Mhm.
right?
There's an argument for both sides. Yes, there's an argument to that. There's also an argument of, home prices have increased, for as long as we've been tracking it. And rents have increased.
And will continue to.
So it's like, if it at least covers it, it's like, do you want to play the game? Some people are fine doing that if they have the income
Building
to cover it.
way out future
Yeah,
wealth.
but personally, and I know Bill and Wendy are the same way. If it's not cash flowing, we're not
going to buy it for the cherry on top.
No, it's got to have both.
Right.
Yeah.
Right. Okay. So where were we going with
I
that?
love
before
this
I got
comment
us off track?
this comment from Chandler. Break even, no bueno. Yes, we're doing this
Thank
just
you.
to learn how it's done.
Yeah.
And then we get to the commercial side. So like multifamily or something like that, it's considered commercial. It's a 1.2 DSCR. So they won't do 1-to-1. Or at least we won't. I don't know anyone out there
Yeah.
who does.
Yeah.
If
And you
find
shouldn't
someone-
either.
Yeah, if you find someone, I mean, multifamily, if you're running a 1-to-1, that's
Don't
that's
set
even
yourself
more
up to
that's even
fail.
more of a gamble than a single family.
Yeah.
Yeah, absolutely. But it has to do with what your payments are based on the loan amount. So if you need a higher loan amount to get you started,
Mhm.
and then maybe pay some of that down, or if you, I would say it's a temporary loan, but we're talking long-term financing here.
Yeah.
Me personally, I don't want to be leveraged in any property more than 70% of the value, because even in 08, 09, 10 and 11, as values went down, most of the country did not dip below 75% of their original value.
Unless you were in the bubble areas.
Yeah, there are some areas that did,
Miami.
obviously, but the vast majority
California.
of the country stayed above
Let's not
that. So
talk
you
about
don't want to be upside down. So
Yeah.
leverage is good
Yeah.
because it creates assets.
But not too much
But
leverage.
you got to be careful.
Well, and then we want to talk about rates for sure. I think we mentioned this last week, but I want to stress, like, people are freaking out seeing 6%
Woo!
interest rates.
Please, that's still good.
Inflation was 7%. You're on a 30-year fixed mortgage at 6%. That's still technically free money.
That's right. That's right. That's right. People don't see it that way.
Well, that said, what's happening in the market right now is kind of a panic when it comes to the wholesale, mainly the wholesale lenders out there. If the market rises 75 basis points, they may bump the rates up 125 basis points.
Correct.
Because they're concerned that by the time they get the loan closed,
Mhm.
They package it up, they sell it to Wall Street, it will go up another 75 basis
Right.
points before they get it there, and then they're losing money.
Yeah, I want to explain this to people because I've had to explain this to a lot of customers that we have. Like, when these loans get closed on the long-term side, it's not like our fund where we just hold the paper in-house. That doesn't happen because you're talking such low rates. They need to be aggregated and securitized, which means you bundle 100, 200, 300 million of value or loans together, and then you sell them, and it takes weeks, months to do that. And then in that time frame where you closed a loan to when you got the securitization done, this market that we're in right now has shifted so much that what you closed isn't what you're not getting the spread on the securitization that you are looking for.
Yeah, there's a lot of 3% money out there that they're lucky to get 5 for, right?
Yeah. So what's happening is we and everyone else in the space, we're trying to get ahead of the volatility of the market.
Mhm.
So we're trying to make sure that what we close in 30 to 60 days can still be securitized.
Great explanation.
And like I said, they're panicking. They don't know, so they're putting a cushion
Yeah.
in those rates.
Yeah.
But hopefully it will stabilize a little bit. The Fed, remember, only raised rates 0.25%.
Yeah,
Mhm.
that's right.
So a lot of this is a little market panic.
Yeah,
Correct.
exactly.
And remember, when was the last time we were in a rising rate environment?
It's a
been a
long
while.
time. Yeah.
It's been a while.
So
Yeah.
people don't know how to handle this.
And good of, I think for most platforms going forward, track the 5-year treasury and add between 300 and 400 basis points, which is 3 to 4% to it. And that's probably where most people are going to be at on the 30-year fixed,
Right.
on the investor loans.
Yeah, that's a good way to.
Yeah.
to
If you
measure
if you
that.
track that, where the 2-year treasury is like right at 2.5% or something like that. So track that, and then then you'll know kind of where it'll be at, and it'll depend on, again, loan to value,
Mhm.
credit score, whether it's a cash out,
Maybe even first time investor.
first time investor experience level, whether it's a
Mhm.
cash out, it's a rate term refinance or a purchase. So there's a lot of the factors that will vary that, but just know that would put you somewhere between 5.5 and 6 right now.
Mhm. And that holds true whether you're dealing with us or any other
Mhm.
lender out there, because we all basically run to the same people, don't we?
Yeah. Yeah.
So yeah.
And to put a optimistic twist on this, there's always opportunity.
Wait,
And
you
one-
do?
I know I'm usually the Debbie Downer.
Yes, he
Hey,
is.
let me put an optimistic twist on this.
Whee!
My first home, and I know I've said this before, when I bought my first home, it was 1978. Jimmy Carter was president. My FHA rate was 14.5%.
Mhm.
People were still buying homes then.
Mhm.
What happens when we are in a higher interest rate environment? The appreciation percentage
Slows
is
down just
going
a
to
little.
slow down.
Mhm.
Yep.
We are not going to go, and this is my personal opinion. There's no guarantee, but we have not caught up with the increase in family formations. And what I mean by that is builders have not been building new homes.
Yeah,
And we have a shortage in housing. So
of new construction.
people still have to have a place to live.
Yeah.
So
Mhm.
there's still going to be plenty of demand for homes, but I'm predicting that the rate of growth is just going to slow down, which we need to, because it's crazy right now.
Mhm. That's right.
And I don't know if we talked about this last time, but yeah, the size of the home is going to decrease. I mean, when that's what happens when you
Yeah.
have higher rate,
Yes.
the square footage goes down because people start thinking, what do I need as opposed to what do I want?
Right.
It's funny, the 50s going into the probably into the late 60s, we still had large homes,
Mhm.
but they had the big deal was to have a large room count, not large rooms.
Right.
Yeah.
Right.
So the bigger homes felt so cramped because you had all these little rooms
Yeah.
everywhere.
Yeah.
And then, of course, in the 70s, they started opening it up a little bit. And then in the 80s, even more.
And now it's all one big room, right?
And, yeah.
Mhm.
And then, of course, COVID brought us back into the smaller rooms because everybody needed their own private space because we were all stuck together.
Yep, absolutely.
So it's amazing how circumstances change.
That's exactly right.
So
Okay, so I was at the family office event in Florida earlier this week, and I got an interesting statistic about. Reason I'm adding this is because we're still talking about people buying homes and there's
Sure.
a demand for them.
We thought you were just bragging.
Yeah, that's why I'm a little bit darker.
That's right.
They didn't have my room ready until 4:30 in the afternoon, so I was stuck at the pool and the tiki bar along
Yeah,
the Intercoastal
poor
Waterway
guy.
the whole day.
Oh.
Darn it. So institutions buying homes, we keep hearing about this, that they're buying up everything.
So are you referring to like Open Door and that kind
I'm
of?
talking about large hedge funds.
Okay.
that are-
BlackRock.
And yes,
Mhm.
they
Yeah.
they're part of them, but Open Door buys homes and turns around and sells them
Mm-hmm.
for the most part.
Yeah.
We're talking about hedge funds that are buying them to hold and rent out.
Gotcha.
BlackRock would be the
And
biggest and the most famous, I'm sure.
And it's been difficult for them to manage those properties, but they're finding ways. But if you think most of these single family rental homes are now in the hands of the institutions, you would be wrong. Right now, statistically, they only have 2.8% of the
Really?
market. Yes.
That's interesting.
Now, it's not that way with apartment complexes, obviously. They are much higher. They're like 30 some odd percent.
Yeah.
But right now, there's a lot of homes to go. So if you're a
Well, 'cause-
wholesaler in the business,
Because think about it.
Yeah.
I mean, they're buying nationally.
Yeah.
The box that they have to buy in doesn't encompass. It only encompasses,
Total mainstream
yeah,
America.
major metro areas, and only
Mhm.
certain parts of those, given the bedroom count.
Right.
Because they're not going out and buying 2 1s.
Right.
but
Right.
they have an appetite. So
Yeah.
those guidelines may loosen up a little bit.
Mm.
But if you're in the wholesale business, it's an opportunity instead of trying to compete with these folks, try and work with them.
And the
Buy
second and
homes,
third
sell
tier
them.
cities are big. I mean, that's where the deals are.
Mhm. Yeah, this is where the deals are. And you said work with them, but what we're seeing on that side is you have to own the property now, in a lot of cases,
Yeah.
before you can sell to them.
Yeah.
So-
for like 60 days, 90 days.
Mhm.
What's
So
that?
wholesalers who want to capitalize on that, and maybe who did early on selling to the institutions, you have to actually find capital and short term, long term, whatever the case may be, capital to buy those, hold them, and season them for the required period.
Right.
Yeah, that said, they are not interested in buying contracts.
Correct.
They want to buy properties. That's
right.
it.
Right.
So you better own it before you're able to
Mhm.
move it.
Yeah, for sure.
Another thing I heard earlier in the week too, when they did the GDP for the month, they also included a 7.2% inflation rate
Yeah.
year over year for this past month.
That's why 6% still good on a 30-year
That's
mortgage.
right.
But the other
That's
thing
right.
is too, if you hold hard assets, what does that mean? That means that this hard asset is being inflated in value too.
Yeah. Yeah.
I think we call that appreciation.
Yeah.
Well, there's lots
It's
of
only a hard asset when the tenant moves out. Whoosh.
Oh man.
Sorry.
That's all right.
But no, that's it's a good point. I mean, if if you can find 5% rates, 6% rate, even you can get 7% rates right now. I mean, I think that's still good. I mean,
Absolutely.
because again, holding on to the assets, getting the assets and holding on to them, that's what you want to do.
Yeah.
I mean, again, there's everyone has their own box and their own strategy, and selling these things to be beneficial. I'm an advocate for holding assets.
Well, with the rise in interest rates too, those of you who have interest rates that are 3%, 2.5%, there's plenty of you out there that are now at a point where you want to sell your house, move to a different place. What a great opportunity to be able to wrap the mortgage and seller finance it, right?
Yeah. Oh my gosh.
And
yes.
and because nobody's going to get a 6% or lower than that rate anymore. It's they're just not out there. And what a great opportunity to
Great point.
work a little income, get a nice down payment, because I'm sure your house has increased in value.
Mhm.
Well, as the Debbie Downer in the group, all
We have to go,
mortgage-
folks.
I would say the vast majority, at least every note that I've ever seen from an institutional lender,
Mhm.
has a due on sale clause,
They do.
which means if you sell the house, then you're supposed to pay off this note. Now, I've never seen a mortgage company complain about getting their mortgage payments.
Yeah.
It's only when it starts to go south that they.
Well, you
take
have to have the
advantage of that
proper
clause.
paperwork in place for sure
But they
to make that work.
No, I get that, but they still have the right to demand.
They
payment.
do, but it very rarely happens. But thank you, Debbie. We appreciate that.
Hey, full disclosure.
Yeah.
You need to be aware of it. Again, the only time I have ever heard that people exercise that clause was during, the crash,
Mhm.
when somebody was trying to use the that government money to refinance the house without having to show any income and that
Yeah.
kind of thing. And people were trying to refinance a house that they were renting out that was originally their primary residence.
Yeah.
And then they went, no, we're going to call this due now because you don't owe that much money on it.
Yeah, read your security instrument. Be aware.
Yep.
Okay. Anything else we want to add to this?
No, I mean, we anticipate, again, multifamily right now is huge. It has been. That's no news, but it's still happening.
Self-storage is great.
Self-storage is still good. Again, affordable single-family homes. If you can get the land for the right price,
Yeah, that's the key.
in the right, in an area that's where people want to be, build it. Assuming you can get the lumber.
Yeah, and make sure that whoever does your permitting and zoning changes and all that good stuff with the city or the county, make sure that you understand there's a waiting list for all of that just about everywhere. In fact, you're building a house and you just ran into a 4-month wait just for them to come perk your land?
5-month wait for them to just come do the perk test, which we're not going to wait that long. We had to hire a private firm to do it. but-
which costs you a lot more
which
money
costs
to do.
you a lot more.
Yeah.
See, Scott said, how long will prices continue to rise? As
Ever?
long as everyone
Forever?
can bear it.
That's a golden question.
And yeah, well, I don't see prices not rising anytime soon.
Yeah.
The rate of the amount they'll rise or the percentage is going to slow down. Right now, I don't see that slowing down until probably adding another 200, 300 basis points to the rates. Then we'll start seeing.
Yeah, I would say once you
It
start
slow
hitting,
down a
once you
little
start hitting about 7.5%, 8%, if interest rates outpace the inflationary rate, then yes, you're going to see it.
Mhm.
You're going to see it slow down.
Well,
Yeah. You'll see hard money rates go up too.
And
Hard
again,
money
this-
rates will go up.
Mhm.
Because when even government-backed entities or Fannie and Freddie on the investor loans are mid-5s
Mhm.
right now.
Yeah.
Yeah.
I mean, and they were 2 months ago. They were in the low 3s.
Yeah. Listen, we've been riding this party wave for a very long time.
Yep.
And, buckle down, get ready, be smart, have some cash. What are you saying? 4 to 6 months of bills for your company.
Yeah.
Dry powder. Yeah.
Some people say 6 months of all your expenses for your business should be in cash right now.
Be smart. We just don't know.
It's just precaution. That's all.
Yeah.
We're not saying that everything's going to come crashing down. I look at the Fed, and they really don't want to raise rates because when the Fed raises rates, that means all the government bills go up.
Mhm.
And the government wants to spend money that they don't have. They don't want to pay payments on money that they don't have.
Yeah.
So they're under a lot of pressure to keep the rates low. Plus, every time they raise rates a little bit, the stock market freaks out. But it's their own fault because they're always behind.
Yeah.
Just so you know, the Fed does not lead the charge in rates going up.
That's
All
right.
they do is follow the market.
That's right.
Alistair
McDonald.
Taylor. Trey
Alistair
Taylor.
McDonald
Yeah. That's
had a chart showing every single rate increase, and the Fed was always behind the market increase. So
Yeah.
if you think that the Fed sets the rates, you're not correct.
that's right.
They follow the rates.
And you can learn even more in depth about that when you attend Sonrisers every Friday morning online at
Mhm.
7:30 a.m. I don't know if Sharub or Scott has the link for that Sonrisers, but you can always.
Either way, it'll be in the chat.
Yeah, we'll throw it in
we'll put it in the chat
So
for
even
that.
after we're gone, it will remain
Yeah, but
because
we have
everything
a-
remains on the internet.
That's right. We have a guy, Brian Maddox, who talks about the market. He does just a fabulous job of sharing what's going on every week.
Yep.
So we will cover that every week. So, when you get a chance, get on that. It's Sonrisers. SON is how we spell that. Sonrisers. There's a Facebook page too, so it'll be posted on that on Facebook for the Sonrisers group.
Well, I know Brian's very happy about gas prices right now since he drives a Tesla.
Actually, it just dropped $6 last night. So
Nice.
so we'll see how that
Talking
works.
about the oil price.
Yeah.
barrel
But
prices.
and remember too, in 2008, we had a strange pot of soup at that point too.
Mhm.
We didn't know what to expect. We're kind of sitting in the same boat, not the same type of upcoming recession, but we got a lot of unusual factors that we're dealing with right now.
Listen, everything is cyclical. You can't ride that horse forever.
That's right. That's
Especially
right.
tornadoes, right?
But every change is an opportunity. So keep your head up.
Yeah.
All right, folks. Thank you so much for joining us on the Real Estate Investor Show. Real Estate Investor Show. That's what I just said, didn't
Yes,
You
that's
sure
it.
did.
That would be hard money for real estate investors. We are Carolina Capital Management, and we are lenders in the Southeast for real estate investors. If you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and sign up with Wednesdays with Wendy. And don't forget, we're now on Rumble. Yay!
Yeah, ready
Check
to
it out
rumble.
over there.
Let's get ready.
That's right.
Talk
We
to you
need a
guys
mic
next
to
week.
hang from here.
Bye, y'all.
Bye.